Welcome all to a webinar organized by the IFA branch Hong Kong, and which also has been promoted with the other IFA branches of New York and several APAC branches, such as in Australia, New Zealand, Singapore, Malaysia, and the UAE. Our topic for today, the Metaverse, cryptocurrencies, NFTs, why we tax practitioners care. So this begs the question, do other people, institutions care? It seems though that government departments care. On the 8th of February 2022, the US Department of Justice stated, today's arrest in the Department of Justice's largest financial seizure ever shows that cryptocurrency is not a safe haven for criminals, that the department can follow the money through the blockchain, no matter what form it takes. Cryptocurrency is not a safe haven for money laundering or lawlessness within our financial system. And this was a statement with regards to the arrest of two individuals that were arrested for laundering cryptocurrency and conspiracy to defraud the United States in respect of a 2016 Bitfinex hack, size $3.6 billion in stolen cryptocurrency. Closer to home here in Hong Kong, the Hong Kong tax authorities and the police care. In the beginning of this year and during the year of 2021, we've seen an increase of romantic scamming. In a typical situation, a man, acting or dressed, I should say, like a woman, tries to seduce a man, read his or her victim, to invest together with her in a fund or a stock through a fake platform, thereby using cryptocurrencies as a payment method. And when the victim tries to withdraw his funds, as he had enough of her love, fake withholding taxes need to be paid first to the Hong Kong tax authorities, obviously into the account of the fraudsters. The UK tax authorities care. On the 14th of February 2022, HMRC, the UK tax authorities, said in respect of a crypto asset fraud case of £1 million, this serves as a warning to anyone who thinks that they can use crypto assets to hide money from HMRC. We constantly adapt new technology to ensure we keep pace with how criminals and evaders look to conceal their assets. Individuals and companies care. They want to invest, make a profit with crypto assets, or should we say gamble. And recently we have seen another group that popped up who cares. People that are based in Ukraine, Russia, and Belarus, or have dealings with those countries. They start using crypto assets to also move monies around. So, should we tax practitioners also care? My name is Willem-Jan Hoekland. I'm chair of the IFA branch Hong Kong, and with me are Brett Cotler, Toby Eccleston, and Will Edmonds. Just a quick introduction. Brett Cotler is an attorney in Seward and Kissel LLP's blockchain and taxation practices. Brett advises blockchain companies, investment funds, their managers, and public and private companies on US federal income state tax matters, including partnership, corporate, and international tax matters. Brett advises on business transactions, token issuances, and other security offerings and joint ventures. Will Edmonds is a senior policy advisor for New Zealand's inland revenue. He has recently advised the government on taxation of cryptocurrencies, with changes to exclude cryptocurrencies from GST and New Zealand's financial arrangements rules, due to be enacted in March 2022. And Toby Eccleston. Toby brings more than 20 years of experience to his role as a partner in Greenwood's and Herbert Smith Freehills Melbourne office. He specializes in general corporate and mergers and acquisition taxation matters, with a particular focus on private equity and venture capital. He has also a particular interest in the emerging issues relating to Web3 and cryptocurrencies, and has assisted FinTech Australia in submissions to the Australian government on these matters. So, welcome all. Also a very warm welcome to our participants. At the moment we are at 91 participants. that should join us from various jurisdictions on this call. If you have any questions, please raise them through the chat group, and we will try to answer them at the end. Please note, of course, that we probably don't have the answers to all your questions, or maybe most of your questions, as most of this topic is still not really regulated. Although one, of course, indeed could say that in general, most of these transactions are taxable somehow. We know now, or as a result of my introduction, that the US and UK expressly stated that actually you cannot run away from money laundering or fraud, such as tax fraud, by using actually any crypto assets. So, so the question is actually, how has that been in Australia and New Zealand? Whether there are any outspoken or particular matters that have been addressed on this topic. So maybe Will wants to start off, and then Toby, and of course, if Brett has anything to add to that, that would be great.
Great, thank you, Willem. So I guess I come at these things from a slightly different perspective, being, part of a tax authority. So I'm not at the coalface advising clients, but it's more from a tax policy perspective, trying to work out, what laws should apply in respect of the taxation of crypto assets. So the New Zealand government's position has been to ensure that crypto assets receive a neutral tax treatment compared to other assets. So that's been our policy objective. So we don't want crypto assets to have an unfavorable treatment, say compared to money or shares, for example, but we don't want them to have a concessionary treatment either. So we've got published statements and guidance on our website, and that sets out the tax treatment of crypto assets. And we've also got published public rulings, which answer more complex and technical questions. But like in a nutshell, in New Zealand for income tax, most crypto assets are subject to income tax, and that would be on a realization basis. So what that means is you buy a crypto asset and then you sell it for a profit, that in most cases will be subject to tax. In terms of GST or VAT, as some of you call it, crypto assets are excluded from GST in New Zealand. However, NFTs or non-fungible tokens, they remain subject to GST. So that's, in a nutshell, our position, and we have guidance on our website to assist taxpayers.
Toby?
Yeah, thanks, Will. So Australia has been ramping up the announcements of late from all the relevant authorities. The head of the Reserve Bank of Australia was in the paper recently saying that there was an urgent need for regulation of the space in respect of crypto tokens, particularly in respect to ensure that the payment system remains stable. Similarly, the head of the Australian Securities Investments Council was requesting urgent powers to ensure appropriate regulation of that, of the space. Balancing that, the Australian government or the Australian Senate has been holding a long-running inquiry into various matters relating to the financial system, and held a specific part of the inquiry in relation to crypto assets. And so they released that report late last year, and then there was an announcement on Monday where the government released a paper on licensing and custodial aspects of crypto assets. And what they are in particular trying to achieve is a balance between ensuring that Australia has some part, or they would like to think, a leading role to play in the innovation in this space, but also ensuring investor protection. The other part of the announcement on Monday was the Treasurer engaged the Australian Board of Tax, which is an advisory board to the Australian government, to undertake a sort of root and branch review of digital assets and how that fits in with the Australian taxation system, in particular emerging issues analysing how other jurisdictions are looking at these issues, and also considering what changes, if any, would be required to Australia's tax law to cover off these issues. The timing for that is that the Border Tax will aim to report back to the government by the end of 2022, and then hopefully they'll be enacting whatever legislation is required as a matter of speed after that.
Brett, do you want to say something?
Yeah, so it's been well publicized for the past several years that in the United States, the Securities and Exchange Commission, the Commodities and Futures Trading Commission, and the Internal Revenue Service have all released sub-regulatory guidance regarding, if not, some of it's just been focused on Bitcoin and Ether, but more generally cryptocurrencies. I'm sure people in the industry would like more clarity, the faster release of guidance. But it's certainly been, at least on the tax front, a trickle. And most recently, about 2 weeks ago, the Biden administration has signed an executive order about not researching cryptocurrency, but kind of looking at it holistically and seeking feedback from the various executive agencies and how the United States can create better policy. The stated goal in the executive order was to protect U.S. consumers, investors, and businesses, foster financial stability and a competitive business environment. And as you read through the executive order, what jumped out at me was, how do we bring crypto into the mainstream, regulate it, but do so in a thoughtful way that we don't stifle innovation? So that'll be interesting to see what comes of it. The two action points from this executive order was, one, explore a U.S. centralized bank decentralized currency, a CBDC, if you're familiar with the acronym. But also to have the various executive agencies report back to the presidential administration with policy proposals and things that the government can do to further the goals of fostering business, fostering innovation, but do so in a thoughtful manner.
Yeah, thank you all. In Hong Kong, because I also have to talk about Hong Kong, we had some arrests, but that was mostly it. If you look at the tax authorities in terms of guidelines, I looked at one of our papers, what we call a DIPN, as a kind of guideline, not binding, but the Hong Kong tax authorities don't spend more than 3 pages on this matter. So I think Hong Kong probably can learn from your jurisdictions, for sure. So going to the next question or issue, and I think Will already addressed it partly, but crypto assets, being the virtual currency or the NFT, they are of course on the radar of many governments. Some ban it, make it considered as an illegal activity, like in mainland China, but also many other jurisdictions. But most governments, I think they realize it doesn't really go away, so they start to regulate it, create a legal framework, and or provide guidelines. Sometimes, of course, they rely on existing rules that are already in place. Of course, these guidelines of these existing legal framework is, of course, often also the starting point for the tax authorities. So as far as maybe not addressed yet, where do we stand actually in Australia, New Zealand, and also in the United States with respect to the regulatory, legal, and tax framework within your country? Maybe just a brief overview, and whether or not there are any contradictions.
I'll start. So in Australia, the ATO issued some guidance starting back in 2014, and there has been additional guidance provided on the Australian Taxation Office website. So there's some public ruling, some guidance just on its website. And then there are also edited extracts of private binding rulings that have been sought by private taxpayers in relation to particular transactions. That guidance has slowed down quite considerably, and there is a case currently being before the Australian or the Administrative Appeals Tribunal in relation to a private ruling relating to a taxpayer who acquired some ETH and what the tax implications were when there was the chain split, when ETH split into Ethereum and Ethereum Classic, and then the taxpayer used some of that Ethereum to acquire a non-fungible token. So that is slowly making its way through the courts. The taxpayer, as I understand, has, or from the taxpayer's perspective, the ATO has sort of been dragging its heels, as I understand from sort of back channels. That may be because there is a difference of opinion within the Australian Tax Office as to how these things should be administered. So we're sort of waiting a bit on how that all plays out. The other thing that probably is of most relevance, that back in 2014, the Australian Taxation Office published a public ruling stating that Bitcoin wasn't foreign currency on the basis that it wasn't legal tender of any country. Now, that was obviously correct at that time. Whether that needs to be updated in light of El Salvador treating Bitcoin as legal tender within that country, and what that means is yet to be fully considered.
So Toby, I can imagine that the authorities, that first case you mentioned, that they want to get it right, because that's setting a example, right, for future type of transactions, similar type of transactions.
Yeah, and certainly there's obviously a few things going on there. You've got a chain split, you've got ETH being wrapped into wrapped ETH, and then that being exchanged for a non-fungible token, and whether that token is what's called a personal use asset, and therefore has certain CGT or capital gains tax concessions available. So there's a sort of number of issues that arise on any type of transaction where you're dealing with crypto assets.
Yeah. We will, by the way, to the participants, we will explain some of the terminology later on. So don't be afraid. Don't run off. Brett?
Yeah. So in the United States, the IRS, our taxing agency, hasn't. They've released the first guidance in 2014, and then held off releasing any further guidance until 2019. And since then, it's been a slow trickle. What we know is that cryptocurrency is treated as property and not a not currency for tax purposes, similar to the Australian rule. So the U.S. tax rules that apply to FX trades, business units that are denominated out not in the U.S. dollar, specialized rules that would apply in those contexts don't apply to cryptocurrency. So that we've known since 2014, and what we've learned since then was that trading crypto for crypto, that's a taxable event. Mining crypto, that's taxable, could even be self-employment income. And then hard forks and airdrops are types of transactions that could happen in the blockchain world. And those we've discovered, those are taxable. I don't think that was a surprise to anyone when those rulings came out. What we all know is that this industry moves very quickly, certainly faster than the Internal Revenue Service moves. I think the other federal agencies have done a better job keeping up. I think the SEC and CFTC have done a better job at working with attorneys and other market participants to at least put out an informal view of how those agencies are looking at cryptocurrency and industry developments from a regulatory perspective. On the non-tax side, I think what people are concerned about is, initially is one, are cryptocurrencies a security or are they commodities? I think it's pretty well established that Bitcoin is a commodity. Most people are comfortable treating Ethereum as a commodity, even though there's no concrete authority for it. That the basis for that view kind of stems from a speech given by one of the SEC directors several years ago. So it's not binding authority, but pretty persuasive. And then if it's not a security, is the thing when it was offered in a manner that makes it a securities offering? And that could put you back into the regulation of the SEC. So there's all these questions about, what are you offering? How are you offering it? If it is a security or a securities offering, are you registered with the SEC or otherwise exempt from registration, meaning you're either offering to high net worth investors or to non-US persons in a Reg S offering, things like that. So that's what people focus on from at least the regulatory non-tax side of things.
But the conclusion, everything is taxable.
Oh, on the tax side, certainly.
Will?
Yeah, so just echoing what Brett said. So from a regulatory perspective, the Financial Markets Authority in New Zealand does not regulate crypto assets generally. However, they do regulate crypto asset issuers, such as exchanges, to the extent that they are issuing crypto assets that are financial products or providing financial services. And they do provide guidance, on their website in terms of managing risks with trading crypto assets. Obviously, being unregulated is extremely risky, and there are opportunities for people to get scammed. Anecdotally, I read an article the other day about a teenager in New Zealand who had made $100 million through an NFT issue. And some people were a little upset as the NFTs that he provided hadn't lived up to expectations. But because, it's not a regulated area, there's nothing unlawful in that. But, obviously compared to traditional financial products, regulation is lagging behind in that, to that sense. In terms of tax, I touched on that slightly earlier. But our Inland Revenue website sets out guidance. It's quite clear in terms of the tax position in respect of crypto assets. So crypto assets are property treated on revenue accounts. So you buy a crypto asset, you sell it. Pretty much all cases, it's going to be subject to tax. And then there's GST is the other side of the coin. So we've recently had a bill going through Parliament, and that's excluding crypto assets from GST, because the current position, prior to this change that we're putting through, was quite uncertain. So a crypto asset could be subject to GST at our standard rate of 15%. It could be zero rated. It could be an exempt financial service. In some instances, you can get a double taxation problem. So if you were to buy a car with Bitcoin, and then you want to if you're to sell a coin with Bitcoin and then you want to convert that Bitcoin back into a fiat currency, there could be GST, a double taxation problem if that crypto asset was then subject to GST upon exchange into fiat. So what we've done is we've excluded crypto assets from GST, just like money and shares. They're not subject to GST in New Zealand, but as I mentioned before, NFTs, as a unique digital asset, they remain subject to GST in New Zealand.
Yeah, I think that's also the position in Europe. Actually, I think that cryptocurrencies exchanges that doesn't attract any VAT. I'm just wondering, maybe a question to all of you, but has there been any deviation between or conflict with what the regulatory says and your local tax authorities?
I don't think so, at least not in the United States. I think, the general view in the tax world is that, we're treating this as an asset and not necessarily broadly as an asset. Certain cryptocurrencies and certain products might have a more definitive treatment. But I think that generally aligns with how the other regulators are treating it. Whether it's a commodity, whether it's similar to a commodity, or it is a commodity, or it's a security, things like that. So I think within the tax realm, we have this kind of general category of property or asset, and then that breaks down to commodities, stocks, securities, crypto, things like that. So I think in that regard, the taxonomy generally aligns between regulatory and tax.
Yeah,
I agree with that perspective in terms of, you mentioned staking. I mean, in general, the sale of a crypto asset, it's subject to income tax. And I think that's quite clear across a number of jurisdictions. Sometimes the manner in which that tax arises can be different. For example, with staking, we have a set of rules called the financial arrangement rules, and they apply accrual-based taxation. So instead of, paying tax on a realization basis, the tax will apply, across the life of the arrangement. And in some cases, staking, to the extent that it's equivalent to a debt arrangement. So that's where, you receive a fixed return that's known to the holder in advance. And in those cases, that would be subject to our financial arrangement rules and subject to an accrual-based tax, as opposed to tax on a realization basis. I mean, it can be quite fact specific, but yeah, just to enunciate that general point that, broadly speaking, crypto assets are subject to income tax, but the way in which, the tax can arise, it can be different for different situations, but no conflicts in general between, regulatory and tax.
Okay, so just to move on, just about Hong Kong, very briefly, we've had the HKMA, the Hong Kong Monetary Authorities, issued a discussion paper on crypto assets and stablecoins. Stablecoins are actually cryptocurrencies that are backed by, or actually pegged, I should say, to another more stable type of currency, or maybe a metal. But the paper really focused on stablecoins because that seems to be more commonly accepted than those other unbacked type of cryptocurrency coins. There's no reference about NFTs as such, but the question, of course, how far does it go? This project, this discussion paper, because basically the Hong Kong tax authorities, or the Hong Kong authorities, also looked at its own virtual currency, right, the e-Hong Kong dollar. At the same time, of course, we have mainland China, where crypto assets or currencies are banned. So the question is whether or not it will really develop in Hong Kong as such. Of course, we hope so. About the tax side, I already mentioned before, there is a DIPN, a guideline, but that's not more than 3 pages. And on top of that, of course, we have no VAT in Hong Kong and no capital gains. So it makes matters a little bit more simple. What I though can say about the DIPN, it seems that they focus on, the tax authorities over here focus on common cryptocurrency business activities. And for that, they refer to the trading of cryptocurrencies, the exchange of those cryptocurrencies, and mining. But what I want to mention here is the exchange of cryptocurrencies. It seems that when you change one currency for another currency, for example, from Bitcoin to Ethereum and the other way around, that potentially might also be seen as a taxable transaction that will be taxed with profits tax. In some other jurisdictions, I know these type of exchanges are not being taxed. They also quickly talk about airdrop and blockchain forks. And these are the transactions where you actually get cryptocurrencies for free. And that it's being said that those ones might be taxable, but at the same time, you could wonder like, what's the value of those airdrops? Because airdrops is really like, it happens when a new currency is being launched. They want to promote this particular currency. And of course, in the beginning, those currencies won't have so much money value. So let's move on because of time. Oh yeah, so this is just to have an explanation on actually what's going on. This is a entrance into the Decentraland Metaverse. So the Metaverse, there are different definitions on what is the Metaverse. This is one I found, and I think it's a good one. It says actually it's the extension of the physical world in the digital world. Over here you see or some avatars, and they walk around on land in these virtual lands. And on those lands, in this virtual world, you will find art galleries, shops, fashion, so actually goods that are being offered quite often through by means of an NFT. And then on top of that, you also have places where you can advertise. You can visit museums. There are holiday resorts, and etc. So and for those services, you have to pay, of course, often, and you can do that in cryptocurrencies. So you see, this is actually a kind of virtual environment where goods and services are being offered. If you zoom in on a Decentraland, all these little black squares actually are land parcels on which you actually can build something. The bigger green square boxes are actually community places, but the small black ones are parcels of land. And if we zoom in a little bit more, this is at the right-hand side, for example, you see the Samsung parcel of land, the 837X. I understand that the Samsung shop 837 is a real shop in New York. And the X is, of course, the Metaverse version. And at the left-hand side, you see some gallerias, like Galleria Seward and Dodi. We'll do a little bit a closer shot a little bit later on. But within those framework, you can see NFTs being offered. This is another example. This is not a Decentraland, but this is what we call the sandbox. Again, extension of the physical world. But this is a little bit less developed than a Decentraland, as such that if you click on the land, not much will happen. There are no physical shops yet. But for some reason, the land sales, the purchase of those parcels, square boxes are more popular because it has to do with the graphics. Next one. Right. So yeah, then there's this question that actually pops up is the virtual economy, whether that runs actually into a similar issue as the digital economy. In other words, whether or not this is a kind of pillar one issue, because pillar one started with having no permanent establishment, only users and participants. And the question is actually what happens if big tech companies also use, for example, the sandbox or Decentraland to sell or to market their productions of their products. Because it's all these platforms actually run on what we call a decentralized type of network, which is a distributed technology ledger. And there is no central server as such. So what if those big tech companies or companies in general would start selling those NFTs or luxury products? And of course, we all know that pillar one relates to group companies that are earn more than 20 billion euro. But if you see that some of the NFTs, one single NFT goes for 69 million already, you could argue that quite quickly also the sales that maybe could take place on these platforms would also quite quickly run into that amount. So how can you tax those participants actually then on those lands? Because how to define a market jurisdiction? I don't know if maybe Will has something to say about it, or Brett, Toby.
Yeah, I mean, I guess there's two issues at play here. One is in terms of, well, for us New Zealand residents, the income that they derive through the metaverse, and then also there's the income that the metaverse itself may derive. So in terms of New Zealand residents, any income they derive through the metaverse, that would be taxable. I mean, they'll be subject to tax on their worldwide income. So if I was to buy a piece of land on the metaverse and sell it for profit, it'd be subject to income tax. But in terms of the virtual economy, I think just like with the digital economy, you run into those same sort of issues. You don't have a physical presence or permanent establishment required to derive income. So I think in the future, perhaps, I mean, this is my personal opinion, but maybe we need to look at as the world becomes more virtual, we need to look at look into value creation or place of consumption, like we do for GST. We have the destination principle. Maybe that sort of framework would help capture some of this. And as you say, well, I mean, we have Pillar 1, and it applies to 20 billion global turnover, potentially dropping, I think, in 7 years to 10 billion. But that is a very high threshold, and I think maybe Binance, as a crypto exchange, might be on the cusp of that. But in the future, there'll be more markets in the metaverse that would reach that threshold. But for now, it's not really an issue that countries will be grappling with. These large companies and the profits that they derive would not be shared for tax purposes. So it's definitely an interesting area.
So Brett, anything to add?
Yeah, I think there's a couple of issues there. I mean, leaving aside even Pillar 1, there's a question of VAT in these sort of transactions, and that will come down to a large degree to where, what is actually, or the terms of the metaverse that in particular, but anytime an Australian company issues or creates an asset and transfers that to someone, it will be subject to, generally, if they're registered for GST, it will be subject to Australian GST unless they can show that it was going to someone outside of Australia. And so there'll be a whole bunch of issues around, well, where is the recipient located? Certainly on an NFT issued by an Australian company recently, they basically outsourced the minting of the NFT to a third party in a tax-friendly jurisdiction where those sort of issues didn't arise, and so they basically engaged that third party to run the whole NFT and would be responsible for delivery of the product when the NFT was finally burned for a bottle of alcohol. But there's sort of just a whole bunch of issues that can arise because, as you say, it's decentralized and it's global. The only other thing I would add is Australia has announced that they're trying to put together some legislation in relation to decentralized autonomous organizations, or DAOs, and create a legal framework for that. And part of that would be also putting in place some form of tax arrangements so that the activities of the DAO are taxed in Australia if it's set up here and managed here.
Yep. Brad, do you want anything to add? You don't need, but if you want.
Sure. I mean, I think, my perspective is when I'm advising clients, it's, the framework that I kind of mentally go through is similar to what Will was saying. I focus on the user and what tax the user would be subject to. I think that depends where they're tax resident. But also for, here would be a metaverse, but what the issuing or dealing entity is, is that centralized, it is decentralized, what really are the economics? And I think if you follow the economics, you can see, okay, where do the profits and losses go? And then, figure out the structure. And then from there, figure out, okay, in what jurisdiction might those P&L be taxable, and then figure out if they are actually taxable under current law. That's at least how I kind of go through it. And it's just following the economics and then let the tax follow from there.
Thank you. Okay, well, we talked about NFTs. Let's make it a little bit more visual. So early on, I talked about some of the galleries. This one is one of them. This is so-called the Dodi gallery on Decentraland. So this is the avatar, goes inside into a gallery, and then stands in front of this NFT. And that shows actually you can buy this one. Well, this one you cannot buy, but in certain circumstances you can buy it. It says here, not for sale. But you can buy it on OpenSea. Again, not this one, but at the right-hand side, you see like what the history is of that NFT and who actually made it. This is another example of being in a gallery on the Metaverse. Of course, it could be different artists, right, that create the NFT and want to offer that. So this one is by a person called Awer, and so you can buy this NFT. And maybe just for people to have a little bit more knowledge about NFT, as far as you don't know, NFT of course stands for non-fungible token. So it's a crypto asset, and you usually would buy it with a currency such as Ethereum. So basically what it is it is in this particular case, for example, with art, it's just a kind of PDF that has been digitalized, or is digitalized art, and then it has been transformed into the blockchain technology. They're called non-fungible tokens because they cannot be replaced by another NFT. That's in contrast with fungible cryptocurrencies. They're fungible because one Bitcoin you can exchange for another Bitcoin, but with NFT art, you cannot do that. And once they've been created, you can't also delete it. And creating is also called minting. So you can sell it on platforms such as Metaverse, but also just so as we just showed you, but also just you don't need to go into the Metaverse to buy NFTs. You also can just go to what they call OpenSea gallery directly, or another platform called Rarity. And then you can buy it with the currencies, and then it will go into your what they call a hot wallet, or maybe a cold wallet. Hot wallet is like something called like MetaMask, but cold wallet just can be a storage and a USB drive. So why do we have NFTs? Well, it mostly will benefit, of course, artists. Why is that? Because the artist creates the artwork, sells it on, makes of course some profit, but all the time when the NFT is being sold on to other buyers, the artist will get a kind of fee, a kind of a royalty, and that's a result of smart contracts. And so this is actually a way for the artist to digitalize his or her work and to make money. Question, of course, is always, what do you get when you buy an NFT? Because other people still can see your artwork, or the artwork you bought from the creator. The only thing actually you get is actually a kind of unique code that shows that you are, well, somehow still the owner. You don't have the copyright, but somehow the owner. So if we go to the next slide, oh yeah, this is, by the way, CryptoPunk has been sold for a large sum of money, as you can see. There's been a Twitter tweet that has been sold for a large amount of money. There have been basketball cards from LeBron James, and the people artwork, of course, attracted 69 or 70 million US dollar. So the question is, yeah, I just mentioned the characteristics. How would we treat this for tax purposes? Maybe we can discuss that. Brett, maybe?
Sure. So I think first you have creators, that's equivalent to artists. The works of art that they produced, the NFTs, the initial sales, clearly, at least in the United States, me, ordinary income. You also have auctioneers and brokers. There's some pretty high profile sales of NFTs by Christie's and Sotheby's here in the United States. I think, one question in addition to the character of the income for the creator as well, in the United States, we have sales taxes, not VATs or GSTs, but sales taxes are pretty similar. The question is, does the sales tax apply? And that's, here in the United States, there's no federal sales tax. We have the various states, counties, and cities that may impose their own sales tax. So they're all a little different. I'm familiar with New York State's, New York City's, New Jersey's sales tax. And at least in New York, a pure NFT, a digital NFT, should not be subject to sales tax because the New York State sales tax only applies to tangible personal property. The question does come up, okay, what if the NFT is prepackaged with a tangible good or some sort of service or privilege? For instance, it could be access to an event or a concert. Would those bundled goods and services along with the NFT create some sort of bifurcation? And do you have to impose sales tax on what could be the potentially the one part of the transaction? And the answer there would be yes, but again, it depends on the jurisdiction you're dealing with. And then on the investor side, folks like myself, if you're investing in NFT, I mentioned earlier that cryptocurrency is just property, and an NFT would fall in that category, but certain types of NFTs would also constitute a collectible for you, which is a capital gain is taxed at a 20% rate, but collectibles are taxed at a 28% rate, so it's a slightly higher rate. And the term collectible is a term of art. It includes a variety of things, including works of art, but it also includes several other things, and the Internal Revenue Service does have the authority to add more. But right now, so it's interesting, you have, for instance, NBA Top Shots or other sports-themed NFTs. Those are probably not works of art, I don't think. They might be. Versus the sale of the NFT sale by Beeple, that clearly is a work of art. So, you could have different NFTs taxed as different rates. So that's just an additional element for investors.
Will?
Income tax, that's probably, I can dispose of that quicker, but the sale of NFTs is subject to income tax if you purchase it with the intent to dispose of it. And I think in pretty much all cases, it's a speculative investment. People purchase it with the intent to dispose of it and make a profit. So income tax will apply. In terms of GST, so the sale of NFTs are subject to GST in New Zealand. So what that means is, to the extent that as a seller, I'm registered for GST in New Zealand, so if I make 60,000 of taxable supplies or elect to be registered, then I must account for GST on the sale of an NFT to a New Zealand resident. If I sell my NFT to a non-resident, then that's zero rated for GST purposes. And I think Toby mentioned that earlier, and sometimes that can be quite difficult, is working out the residency of the counterparty of the transaction. In most cases, they're probably going to be a non-resident, but that's an open question. The other aspect there is NFTs that are sold by offshore platforms to New Zealand residents. So as we mentioned earlier, there's OpenSea, which is the online platform which people list NFTs for sale. So to the extent that an NFT was sold via OpenSea to a New Zealand resident, that would probably be captured by our remote services rules. So those require platforms that make a certain threshold of supplies to New Zealand residents to actually account for that GST on the sale and remit that to the New Zealand Tax Authority. So that way we're getting the GST. In terms of just general problems, obviously there's the problem mentioned earlier in terms of the residency of the counterparty to the transaction, and there's another problem as well with tax cascades. So in the New Zealand legislation, an NFT is a service for GST purposes. So that means you cannot claim a second-hand goods import tax credit. But complexities aside, but basically, if there's a chain where an NFT is sold from a registered person to an unregistered person, back to a registered person, there can be a scenario where GST gets embedded in the price of the good, well, of the NFT, sorry. So in that sense, you're creating a taxation issue where someone's being overtaxed. So that's a problem that does arise with NFTs that may need to be looked into. And of course, there's other regulatory issues, as you may have already mentioned. It's a great opportunity for money laundering because you can create fictitious value and chuck it through an associated person's transaction. So I can mint an NFT and then I can sell it to myself, for $10 million or something, and then you've created this value and you're using it to launder money, which you don't really get that same problem with traditional crypto assets. They're fungible, there's a huge supply, and they're traded usually at arm's length on a market. Whereas an NFT, it's a specific asset. So you've got that that's CryptoPunk. Someone says it's worth 20 million. It's hard to question, really. It's quite subjective, but yeah.
I'd probably agree mostly. I think with Will, the Australian issues are pretty much the same. One thing I would add is that the Senate report stated that they want to amend the capital gains tax regime for digital asset transactions to only create a taxable event where they genuinely resulted in a clearly definable capital gain or loss. The report didn't go into any detail as to what was clearly definable. They had talked about and rejected the idea that crypto transactions should only be taxable when they were converted either from fiat or back into fiat. So that on-ramp, off-ramp type of idea was rejected. So it'll be interesting to see where that lands. The only other thing I'd mention just on your slide there, Will, was your comment about copyright and the trailing commission that the artist may get. That generally, obviously, there's no, if the artist retains the IP, there's sort of, I wouldn't have thought that would fall within the royalty withholding tax provisions. It's just more a sort of sales commission that gets directed, I think, back to the original artist. The only other thing to mention is sometimes the NFT passes the copyright. So the Bored Ape Yacht Club apes give the holder the right to copyright in respect of their NFT, whereas the CryptoPunks are retained by the organisation.
Yeah, I think you mentioned indeed an interesting point, Toby, about whether or not it's actually a royalty or not, right? The fee being paid. Of course, when you buy and sell the NFT, I think according to our DIPN guidelines, that's probably either subject to profits tax or it is capital gains, which is not being taxed if it's for a long-term investment. But I think with the fee of the royalty, it would be interesting to see how our Hong Kong tax authorities would actually treat that. Because if the artist is in Hong Kong and receives a kind of royalty in Hong Kong, that will be part of the profits tax. But the question is, what if that artist is actually outside of Hong Kong, the original creator of the NFT, and then for some reason the NFT is being sold to a person in Hong Kong. When the person in Hong Kong buys actually the NFT, he pays the reseller an amount, and as far as I understand, because of smart contracts, automatically 2.5%, or that's a common percentage, 2.5% out of that fee is paid as a kind of fee / royalty to this artist in, I don't know where, right? Somewhere outside of Hong Kong. We have some deemed provisions that in that particular case, in those particular cases, the royalty will be then, if it's a royalty, will be considered as taxable. So the person that pays needs to actually withhold a withholding tax. But the question is, of course, how do you know how much you have to withhold anyway, right? Because you don't know, you can't see the royalty stream, you don't know to whom it's paid, etc. So there's also a lot of practical reasons for which I think probably the Hong Kong tax authorities would also not like to consider the royalty as a royalty, but maybe just a kind of disposition of something. So because of the interest of time, we move on a little bit. I want to discuss these fragmented pictures, the Mona Lisa. What if you cut up it in small pieces, right? And why would you do that, by the way? You do that because the Mona Lisa is, of course, very expensive. If you cut it up in rather small pieces, it might become a little bit more cheaper, but then it could also be a regulatory issue. I skipped this question. We have, of course, also the various cryptocurrencies in itself, right? You can trade with that, buy and sell. How would that be taxable, of course, in your particular jurisdiction? I will move on. This is just the reason why I had this picture is because it shows a little bit who is active on the platform. I don't know if you can see my cursor, but over here we have Snoop Dogg, who is selling NFTs on the platform. Over here we have the reason why I showed this one as well, or the previous one, is just to show you the services. Here you can see some people have bought the land and want to put that like to that you advertise on their land. So there are advertisement income. The question is, how would that be taxable? Over here you can even, it says for rent, you can even rent a plot of land. How would that income be taxable? The Walking Dead is there. I think that's probably just a game. And for the people in Hong Kong, we have South China Morning Post here. There's a newspaper in Hong Kong, and they recently sold out, I think, their NFT collectible items. We have Agent Chen over there as well. There's a developer in Hong Kong, and over here is also a developer. So just to show you who is there. This one we won't discuss either. This is just, I think, also something Brad discussed early on. You know, with NFTs, you often have an underlying asset. You could have, of course, the digital art itself, but you also could have a bottle of whiskey. And so how it briefly works is that this bottle of whiskey, for example, is this is called Block Bar. The bottle of whiskey is actually stored in Singapore. And then subsequently people can just buy this NFT and sell it on. And the reason why, and that could be the same with wineries or even land, right? But the reason why people do that is because then it becomes more marketable. This is the Samsung shop I mentioned early on. Inside you can do, Samsung is doing marketing of its products. Well, these are questions we won't discuss now, but that's questions I just raised, right? You know, the services that are provided on those platforms. Here are some legal issues. If you have an interest, they can get a copy of those slides and we'll forward to them. The last question is maybe also of interest. The question is, which jurisdiction has actually the taxing rights? And especially when you start selling an NFT with a land interest to it. Land often, of course, follows the CITES principle, but maybe the country that actually sells the NFT itself and underlying assets want to have taxing rights as well. I just want to address this question 9 and 10, because this is a little bit more policy related. There has been a OECD report about taxing virtual currencies. It does not say much about NFTs itself, because this report is out of 2020. NFTs have become more popular recently, despite the fact, of course, they've been around already since 2014. I just briefly mentioned those 4 points, and if the panel members want to say anything, please add. The first point is valuation, right? These are common tax policy challenges. Of course, tax authorities might want to tax the NFT or the transaction, but how to value that? Because the valuations go very sharply up and down. Another problem is that a lot of those platforms, the trading exchange platforms, they have different pricing. So that makes it also very confusing. So, maybe a question that the panel members want to address is like, as a result of that, and I believe that's the case in New Zealand, should therefore the valuation somehow be left over to the taxpayer?
I mean, I understand where you're coming from. I mean, one common problem with this is, crypto assets are incredibly volatile. So in that sense, you don't want to apply an accrual method of taxation, to large unrealized gains and losses. And then the price jumps up and down all of the time. So I think one key consideration for tax authorities is how to make it easier for people to comply with their tax obligations. And one element of that is, record keeping obligations. And I know there are software tools that can be used to help people, record all the buy and sell transactions that they make in respect of crypto assets. But the other part is, how do you calculate the tax on that? It's not practical necessarily to require someone to pay tax on a realization basis on every single transaction. You're constantly trading in and out, buying and selling at various prices. So something that we would be looking at in New Zealand in the future, obviously subject to resourcing as part of our tax policy work program, is developing a simpler annual calculation method for income tax for crypto assets. That'll make it simpler for taxpayers to comply with, because there are, obviously cases of, someone who has perhaps made $500 or $600 trading crypto assets, a large volume of transactions, but a small amount of money, and they're going to their tax advisor, for assistance, and a bill, just to unwind all of that and work out the tax, can be quite prohibitive, especially if you don't have that software in place and you don't have a simplified method. So I think, that question of value and how can you make tax easier to comply with for taxpayers, definitely an important one.
I think one interesting part that arises with crypto, like particularly on the Ethereum blockchain, you're paying gas fees whenever you're transacting, and so a question as to how those gas fees get allocated between when you're is it allocated to the selling asset and going into that cost base, or does it go into the cost base of the asset that you acquire? I don't think it's clear. When it may just get lost, particularly in where there's numerous transactions. So I'll leave that one for Will to determine.
It's definitely something we'd need to consider when we, when we look into, a simpler annual calculation method, because at the moment, we're just applying tax on a realization basis, and obviously gets confusing with the transaction fees on the network, and also with staking and the profits generated there, and it's definitely something that needs considered policy attention to get that sort of outcome.
Yeah, I saw the UK put out a fairly well, not detailed, but it was a 15-20 page document with 10 or 12 different examples on transactions that may occur with decentralized finance, and how they might be treated. And it's I've been meaning to basically convert that into an Australian context, but it's pretty useful. But it's I mean, there's just so many different types of transactions that can occur. It's going to be there's certainly room for development of guidance for taxpayers.
Yeah, I agree.
Brett?
I think one of the things that I stress to clients and even just friends in the space, non-clients, is on the valuation point, is just adopting a reasonable methodology, applying it consistently. One of the messages that I've heard from the Internal Revenue Service is they're looking to increase taxpayer compliance. Really, the average Joe investor, so they just want people to report it, pay tax on it, do so in a reasonable manner. That's one of their main goals over the past several years. So it's just being consistent with whatever methodology you choose, and then and obviously all that could change if they release new rules about it. But right now, it's find something reasonable, apply it consistently.
These previous question 9. I think I leave it there. Hard forks is a result of like when virtual currencies follow different network policies, then coins are being split. How should you tax that as a tax authority? Should you tax it when they get the free coins or the additional coins, or should you tax it on dispositions? I think that's for governments to discuss. There's also, of course, the issue about stable coins. I think a lot of authorities find it actually rather scary, that development. One of them or two of them are USD Tether and True USD, TUSD. They're back to the dollar, but the question, of course, is always like, what if the virtual currency is not working out? Does it also impact, for example, the dollar itself? And there is this proof of stake consensus mechanism increase. Basically, what it comes down to is that instead of miners, the miners that actually use to create the currencies, there will be stakers actually that create the currencies. And that's more VAT related, I think, more VAT related issues, because we have miners. When miners are being remunerated, the question is always like whether that's subject to VAT. Some authorities think there is not much of a connection between the person that actually pays for it and the miner itself. But when the creating of coins would go towards the proof of stake consensus mechanism, there's a more kind of relationship, and then it would be easier to increase or to levy VAT. And then, of course, the question is whether or not we expect another PEPS 3 or 4 on this matter. So what is it the government's, as a kind of final question, what is the government should focus on?
I mean, I guess I can speak to what the New Zealand government is looking at from a tax policy perspective. So two things really. So obviously first, we've had stuff in the current tax bill to exclude crypto assets from GST and our financial arrangement rule. So that's as good as done. But in terms of the future, obviously subject, to resourcing on our work program, there's two things that we're looking at. One is what I mentioned before in terms of simplifying income tax compliance and record keeping requirements, making it easier for people to comply with their tax obligations. And the second is the OECD work on crypto assets reporting and exchange. So essentially what the OECD are doing, and this is in the early stages, working on a collection and reporting regime whereby crypto asset exchanges would be reporting income information to tax authorities in respect of transactions that their residents undertook on the platforms. That's the real problem, that tax authorities have, is there's that lack of visibility of incomes derived through crypto assets. So, you've got these exchanges as a central hub, they've got robust KYC requirements, to identify, who is the underlying individual behind those transactions. And, that really helps with a transparency gap because you get, information flowing through to the tax authority with regard to incomes earned through crypto assets. And I think the end goal there is, potentially allowing for this income information to be pre-populated in an individual's tax return. And in New Zealand, we have that for employment income and for some forms of investment income, where it's just made simpler for the taxpayer, makes it easier for them to comply. And I think, by and large, that's the main thing in the future, is getting those information flows coming through. And then obviously as crypto assets develop and the metaverse and the NFTs become, more commonplace, I think issues around those will obviously arise. But from a tax policy perspective, at least in New Zealand, we're still very much focused on crypto assets themselves and, improving that transparency gap, helping people comply with their obligations and making it easy for them to do so.
Okay. Brett, Toby, anything, last comments you want to add to that? Remarks?
No, I think I'd just say, it's a movable feast, and it's a fast moving area. The Australian government certainly is trying to push ahead and provide some clarity with its various papers and reports that are being undertaken. So just watch this space.
Yeah, I echo what Will said. It's, if the governments can make it easier for consumers, it'll make things easier for businesses. And I think everybody wants that. And that's not limited to tax, regulatory as well. General comment.
Okay. Okay, thank you. We just want to do the conclusion poll. So what do you think government should mostly focus on, knowing this is a constant evolving area, right? It seems to head towards provide extensive guidance. I think especially in Hong Kong, I would actually assume that the majority of participants are from Hong Kong. So I can imagine that would be one of the conclusions they would like to draw. I also see that some of the questions on the chat already have been answered by our panel members, for which thanks. So we don't need to go into detail anymore. So if you have any additional questions or want to have a copy of the slides, just email me. I also can get you, of course, the contact details of the speakers if you would like. I just want to thank all the panel members, and we hope to see you all soon again.
Thanks, everyone. Have a good day.
Thanks all.